You're listening to the greatest multifamily investment advice show. My name is Adam Ras, and now I'm talking everything multifamily for an in-depth conversation, and I will be diving deep into raising capital, deals, and underwriting process. Welcome back to the greatest multifamily advice show. Today we have Sam Maurice, our today's guest, with more than 20 years in financial and real estate world with different commercial spaces. Please help me to welcome our guest today. How are you, Sam?
Hey, I'm doing great, man. Appreciate being here.
Thanks so much for being with us today, and I appreciate you taking the time.
Yeah.
Sam, your background is really impressive because you're covering a different perspective here, which is the financial world. As a previous president of a bank and moving to the huge multifamily space, what was the motivation for you or the upside to move to the multifamily space and real estate in general?
Yeah, it's really fun. I absolutely love being a banker. It was a great time, man. It taught you so many different things. You got so much exposure to so many different industries,
Mm,
and seeing so many deals. I mean, over that long period, I had about an 18-year career there. I
mm,
got to do just hundreds and hundreds of deals,
mm,
be part of thousands of transactions. It was just really great to be a part of all of that. But at an early age, I actually started passively investing in
mm,
multifamily real estate. So
mm,
I was in my mid 20s when I started recognizing, man, passive income, that's just amazing to have at this point. And so I would start investing into other syndication deals. So I was early on adopter of investing into those types of deals. And in doing that, it really opened my eyes to what all was out there. And so I sold my last bank in 2018. And when I did that, I said, man, I got to go sit on the sidelines for a little while. And so I'm going to go full time into real estate.
mm,
And it was just one of the best decisions I made. It still gave me that high of chasing deals. It gave me that in-depth aspect of looking at all the deals and being able to be really ingrained and get granular into those deals, and to allow me to keep doing the analysis of the things we want. And this time just be on the ownership side where you make a lot more money associated with it.
So you're not just a banker, you're the president of the bank. How you see your experience on financial world help you to underwrite your deal, especially that you were always on the conservative side of the coin. So how does this help you on multifamily?
Yeah, well, so believe it or not, having gone through a lot of different areas and the ups and downs of real estate markets and things, it's allowed me to see, who did what and how they did it,
Mm,
whether that be good or bad for that matter. I mean, we
mm,
had deals that went bad in '08, '09, right? And
mm,
and you could see how those deals went,
mm,
and what the decisions that the ownerships made at that time, whether it was good or bad, the options that they had available to them, and how those worked. And I was from a 10,000 foot picture, I was able to see all of how that was working out, what went well, what didn't go well, how they did what they did,
mm,
who they enlisted to get that help. And just all the different aspects of how people were running different things. And it really it equipped me to be able to go, man, that's the right decision on something when this scenario comes up, or man, that's the absolute wrong decision when this scenario comes
mm,
up. Hey, if you got to take some kind of calculated risk, this would be those areas that you do it in. And so, it taught me a lot being from that perspective, because, your lender is your biggest partner in the deal. It really is, right? I mean, you may
yeah,
go out and raise a whole bunch of money, but the largest amount of cash that comes into those deals is typically from your lender, because we're
yeah.
normally borrowing a lot of that money. And so I was the biggest partner in a lot of these deals, getting to
Mm,
see all those aspects and being able to request anything I needed at that time, whether it be financials or strategy, or having that understanding of what you were doing operationally. And it gave me that additional education. At the time, it wasn't something I was thinking of at the time to be able to jump into full
yeah.
time. It was something, hey, I'm protecting my investment that I'm putting into this deal as in the form of a loan, right?
Mm.
And this is the knowledge base that I just continued to learn over those couple decades of doing it.
So right now, before the show, we were talking about the markets and market fundamentals, and also how this impact your decision to work on your market. Can we little bit have an overview of what is the upside of Texas market, especially that you're focusing more on the San Antonio, Houston corridor on doing multifamily and self-storage? Can you basically highlight the challenges and the upside of your market?
Sure. Yeah, Texas is probably one of the most attractive markets, I think, in the entire United States. As a state, we have in-migration like crazy here. And what that means is we have people moving into this state every day, and in pretty significant amounts too at that point. And in addition to that, one of the bigger factors that we look at too is jobs. The state is still creating a whole lot of jobs, and when you have jobs, you have people that are moving for those jobs. And when people are moving into those areas, they need a place to live, right? So you have gainful employment, right?
Yeah.
And now you're looking for housing associated with that. So we're still real bullish on the state of Texas because of that. And it's actually a fairly diverse state, right? So we're really, a lot of people, when they think Texas, they think oil, right? And although, yeah, that's actually, it is absolutely a portion of the
Republican too
out here. It's actually probably more in, I would say, that Houston area, more so than it would be San Antonio, Dallas, or Austin. But each of the primary cities, they really have their own kind of, their major employment factor. But since since probably the 80s, Houston's really been diversifying out of that oil and gas. They've just been adding a lot more other things. You're seeing now medical hubs and financial hubs and other things that are occurring in the city. But I would just tell you, we're really excited because we keep seeing more and more people moving into the state, right? And jobs being created, which creates the housing, which creates the volume of, that you're going to need to be able to grow from. As far as some of the challenges, I think it's pretty well known that, probably the two biggest challenges for this state as a whole are property taxes.
Yep.
And an insurance cost too, really.
Yeah.
And the reason we bring those two factors up is because they're somewhat out of the hands of the operator, right? Those are not within your control of what you can do. There are things you can do to control that, but you don't have the ability to go, you know what, I'm just going to go ahead and cut property taxes by 50% this year. You just don't have that ability to do that. And so there are certain things and strategies that you can do. I mean, we fight our property taxes every single year. And we have a group that helps us to do that. And so every single year we are challenging and or going to arbitration and or suing the counties that we're in to be able to lower that cost associated with it.
It's more like appealing every year to a little bit.
Correct.
Yeah.
Correct. And there's certain things and strategy you can do. Sometimes we'll share numbers with the county. Sometimes we don't, right? Most of the time we don't. We don't want them knowing our numbers associated with it. But there's certain things that you can do and strategies that you can employ to help mitigate those increases. Insurance has probably been one of the biggest ones, though, in the last 2 years as well. We've had so many catastrophes that have occurred in the state, from massive flooding, hurricanes. We had we called it the Snowmageddon that we had in 19. Which was really interesting. I mean, we had, at the time, our portfolio with the group I was at, we had 484 pipe breaks in one day. So we had 484 pipe breaks in one day. And so that's pretty significant from those kinds of challenges. And the insurance companies have obviously had to shell out a lot of money associated with that. And so we've had insurance companies that have left the market. They're no longer underwriting in the state. They don't want that risk associated with that. And so when you have less competition, the pricing is going to go up because, to underwrite the deals that you need, that's what's happening. So in the past, certain people would go, well, let's just use a plug number. Let's just use, X amount of dollars per door. And that's how we're going to do the underwriting, only to get, when you go out and get your quote, it can be 2X, right? So some of the things that we do for that to help offset that is we partner really well with different property management companies, and mainly our larger management companies that have master portfolios where they have properties all over the country. They get typically better deals than our little syndication company can get, and so we closed a deal in May, so just a couple months ago, and the quote that we were given directly was right around $1,000 a door for the insurance. I know a lot of people, that's not unheard of here in Texas, in
Yeah.
particular near the coast, right? So if you're a tier 1 county,
Especially on the main markets too.
yeah, but by moving it over to our property management's master plan that they had, that cost dropped to about $700 a door. Well, that $300 a door savings more than paid for the property management company. And so it was an easy thing for us to go, hey, if we go with this property management company, they're effectively free to us. Because if we were to go out there and get the property insurance, it would cost us, this, and we can pay the same amount getting insurance and property management for the property. And so there's certain strategies you can do, and there's certain things that you can do to the property to help lower your premiums associated with it, whether it be property insurance or your liability insurance. And so you just have to be cognizant of that when you're underwriting.
I think one of the other questions now about Texas is product number C buildings, especially 1970s products with high maintenance, and how you can actually underwrite the deal when you're working with especially added value products. And this is one of the things, is I think one of the major things, especially with the appreciation of all of the market, not only the C product, but all of the products, especially that you don't have this margin between the interest rate and the cap rate. You don't see an actual margin for your profit. So how you're managing this risk with the C products in your market?
Yeah, so it's pretty specific. One of the things, and you kind of hit the nail on the head right there with the 70s product. So anything that's built before 1980, at least in general for Texas, they were using different materials. And so there's some operational challenges that you have when you're dealing with aluminum wiring or galvanized piping. And so there's some things that you're going to have to think about operationally when you purchase a property like that. You may need to carry an extra half a maintenance person, right, to be able to handle some of the things that inevitably will occur, whether it's plumbing leaks or electrical outings or things of that nature. You're going to have to think about some of that. But really what it comes down to is location of the property, right? And so I look, you can replace anything on a property. Anything is replaceable, right?
Yeah.
Except the location. I can't replace the location.
Yeah.
I can replace anything on a property, but I cannot replace where it's at.
Yeah.
So buying in the right area is still going to be number one to us, because people are going to want to live in certain areas. Now, there's things you can do to upgrade the product, right? And particularly even if it's C-class product, there's certain things you can do to the interiors, make it look nicer, to the exteriors to make it look more appealing, right? But the guts and the bones of it, right, you still are going to have to deal with. And if you know that going in, this is why knowing, we always call it backing the jockey, not the horse. You want somebody who actually knows the product, right? To knows what they're at. This is where boots on the ground knowledge and things like that really come into play, right? Because if you don't know that there's a difference between a 1985 product and a 1975 product, right? You're probably not the guy that anybody should be investing with, because there's difference in that. And the due diligence will tell you what all that stuff is, right? If I don't know that all the aluminum wiring has been pigtailed, well, that's an issue. That's an additional cost that we're going to have to deal with. There's safety issues with that. If I don't know that the federal stab lock breakers need to be replaced, and lenders aren't lending on that type of product right now, or they're going to force you to do it, it's going to show up in their PCA reports, right?
Then you have a problem. Yeah.
You have problems. You're going to have to readjust your budget associated with that to start replacing those, right?
Yeah.
And not only that, the insurance companies don't want to insure if you have that type of product, right? So you have to sit there and go, there's certain things that you may have to change to a 70s type product to make it, one, more insurable, lendable, and to operate the way that you need to operate it so that you can get the returns associated with it. And so if in your underwriting process and due diligence process, you recognize what those hot buttons are, right? And the product is where you want it to be, and it still works for the returns you're trying to give to your investors, you can still do the deal, right? Look, just because a product's built in the 70s doesn't mean it's any good. It just means there's certain things you may have to do to that property to make it, like I said, insurable, lendable, and get the returns for the investors. So you just have to know it. And that's where, like I said, backing the jockey, not the horse, somebody that knows what they're doing is going to enable you as an investor to go, yep, I can get comfortable with that.
100%. I think you mentioned something about the net immigration, and I think one of the biggest issues here, or biggest attraction to Texas, as you mentioned, the net immigration to the Southeast in general, Florida and Texas. But how you see the actual split of the tenants, if it's actual A tenants or B tenants, because when you have a net immigration for only A tenants, then they're going to focus only on A product or B product. Then C product is going to be in trouble unless you see on the ground that this net immigration with A tenants is helping the other C products too.
Yeah, so I'll put it this way. There's a lot of new product being built in Texas, and nobody is building C-class product brand new.
Yeah, of course. 100%.
Right?
Yeah.
And so that's just what it is. And so it's not like there's any more new C product being built, right?
Yeah.
Everything is A product, and the C product's getting older.
Yeah.
And it's being refurbished and things of that nature. And so the new product that's being built is going to be at a specific price point for a specific demographic, right? And does it price certain people out? Yeah, it might. And where do they go? Well, they'll go to B's, right? And when you have that push down,
you go to the C.
The demand goes, everything kind of slows down, right? Yeah, it does. And so, but I would tell you that from a demographic standpoint, the people that are moving to Texas, it is across the board. It's across the board. You have the high-end tech jobs going into Austin, and people ready to spend a lot of money when they get there and are stunned by the pricing and how different it is versus California or something like that.
Yeah.
And they're still making, great money being able to do it, which, it's going to further, it's kind of a high tide raises all boats, right? You may look real smart. Hey, I'm in a C-class product, but with the amount of people that are moving in, everybody's benefiting associated with it.
Yeah.
And so, I mean, I would tell you the demographics that are moving to the state are vast and wide, right? It's everybody who's moving in here. I live in Fort Bend County, which is just west of Harris County of Houston. And it is considered by most to be the most diverse county in the United States of America. So think about that. I mean, we have from all walks of life, from all different types of demographics, all here in this county, which is a fairly large county. I mean, it's, there's a lot of people that live here, but you need all types of product to service all those different demographics, right?
Yeah, 100%.
And you see that throughout Texas, whether it be primary or secondary or tertiary markets.
Yeah, Sam, you for me as I can define you as an advantage player, because you know how the actual financial world work. So my question is, how you see the current recession versus the similar indication on 2008 scenario and 2009? How you see the similarity or the differences between the two recession market?
Yeah, they're different. They're very different. Well, I mean, one, in 08, 09, there wasn't the bailout that we've just had. There wasn't, the government printing, incredible amounts, trillions of dollars, and just giving it to people and giving it to businesses and giving it away. And so there's a chance you delayed the inevitable, right? But I would tell you that, the inflationary environment that we're in right now, it was created by our Fed, right? I don't think anybody can deny that. When you go out and you print, $2 out of every $5 in a matter of 24 months, that's going to have impact on the economy. And so you're seeing some of the ramifications of that and them trying to slow that process with these interest rates going up. The quantitative tightening is probably one of the bigger differences between 08 and 09 and right now. So we've had this quantitative easing going on, and not to get too complex, but you've had the Fed pumping a lot of money into into the system, right? And buying a lot of the bonds and adding to their balance sheet, right? And in the last couple of years, it's ballooned, right? So you've gone from 4 trillion to $9 trillion in debt, and a large portion of that being like the MBS market. You know, the Fed has $2.7 trillion in mortgage-backed securities. And so when it was almost like free money in the single family market and people just borrowing rates, you know, at 3% for 30 years, well, there was a buyer for all that debt.
Yeah.
And that buyer has gone away. And now you're seeing some of the ramifications of that. It'll probably even get a little worse going forward. So you've seen just kind of a shut off in the single family market. Well, part of that is, you know, one of the big players, the Fed, isn't out there buying all that debt anymore.
Yeah.
They're trying to slow that all down. And so, yeah, I mean, it's from a commercial standpoint, you know, we've kind of gone through all the rental relief stuff, and that's really kind of ended at this point. There's still some out there, maybe not so much federally backed, but you're now getting more into a normalized market in my world. And, you know, nobody had the issues that we had in 08, 09 because there was just a ton of money pumped into the system, right? You know, for the guys that took the deferrals and things that were granted to them, I kind of thought that was a double-edged sword. We never did any of that. I thought there was too much stickiness into your business and too much of restrictions of what you could and couldn't do with your own company if you decided to do that. But the CARES Act, you know, it probably helped a few people out. It helped a lot of individuals by just giving them money. But I would tell you, I don't know how well it was utilized. You know, you talk about C-class product. I mean, we knew when people got checks, right? It wasn't necessarily that most of them came and paid all their rent, but you could go to the dumpster and you could see brand new large screen TVs or Xbox boxes and things like that because they were pumping that money into the economy too. And that helped, right? And you take that away, things will slow down, which is what we're seeing right now.
Yeah. I think you mentioned something now I would like to ask you about the market itself. How you see the physical occupancy on Houston market or all of the actual corridor of Texas? How you see the actual physical occupancy rate on the states?
Yeah, I mean, I would say as an overall, it would be stable. I mean, you'd be stabilized, so well north of 90 at this point. Oh yeah,
yeah.
And I would say as a whole too, that way. And so you know, we're still kind of towards the tail end of peak leasing season right now. And so for those properties that probably aren't in that 90, they're probably doing the few things that they need to do to get to that point as we enter into the fall months. But there's demand for the product that's out there. And so you'll have some people employing different marketing strategies, but as an overall, from a physical standpoint, yeah, I mean, we're into the 90s for sure. I will tell you, you know, as an asset manager, and we asset manage all of our properties, we look at it, but we look at it less. We look more at economic occupancy.
Yeah.
That's actually everything that we track. That's actually how we rank all of our property management companies and groups. We actually rank them from an economic standpoint. And for the most part too, collections have been pretty strong for us. You know, you do have some holdovers, you know, for COVID and the things like that, and you know, people that have been gaming the system, but those have been a lot fewer and far between for us. And our economic is running real close to physical,
which is great. Anything above 90 as economic, this is the important thing, because always the actual giveaway here is the occupancy is 97, but the actual economic is 80s. This is the problem when you don't able to collect the actual rent because of as you mentioned, some reliefs or some help from the government or recession, people losing their jobs, not paying. So this is the major, I think, element here. But you're saying that in your market, you're keeping this analysis close by to the actual physical occupancy.
Correct. And so, and we're pretty vigilant, so we're on it, right? But I mean, you talk about things like underwriting or things of that nature. I mean, when we underwrite, everybody typically underwrites their economic occupancy. This is what I'm going to collect, right? And so if you haven't made some adjustments associated with, bad debt, or any other collection issues or concessions or things that you may have to do to be able to keep that economic number, you're really doing a disservice. I mean, you really need to build that into your underwriting models, because one, it's a reality. And two, it's you when you're trying to project returns or things of that nature, it's got to be based on the actual cash that you're collecting, not based upon, hey, I have somebody in that unit. That's great, but unless they're paying, they shouldn't be there.
100%. And this is the difference between a newbies as a sponsor and an experienced sponsor who know how to underwrite the deal conservatively. One of them, as you mentioned, the concessions, the physical, and the economic collection. My next question for your business model is two things, to be honest, is how you see or the upside for you to partner with active syndicators, and at the same time, what was more appealing for you, the syndication model or the fund model?
Yeah, so I'll answer the first one. So we absolutely do partner with other syndicators. So we'll do co-GP deals and we'll do lead GP deals, and a lot of times it's strategic in nature for us. So like we have a deal that we've been doing now for about a year and a half, and our co-GP in that deal, it was a full gut remodel deal, right? And we knew it was going to require boots on the ground, construction management, a lot of that other stuff. And the GP that we brought in for that, very strong in that. That was really his wheelhouse. I mean, he's been a builder since the 90s. He knows exactly what he's looking at. And so we brought him in to be able to help with that oversight and the consistency of it too, so that we can finish out the product and get to the returns that are desired for the investors associated. So we will do strategic partnerships that way, in particular because of knowledge gaps, really, right? And so we just did a co-GP deal last month in Savannah, Georgia. We're very good in Texas. We understand the market really well. We are boots on the ground here. We know everything that we think we need to know for those particular areas before we get into those deals. This particular deal was in Savannah, Georgia, and for lack of better words, we're not experts there. We're just not. We are experts though in financials and doing the asset management and things of that nature, and so in underwriting. And so the deal worked from our world, but we weren't going to be the lead on that deal because we weren't going to be the boots on the ground. We don't have that bandwidth to be able to get out there. And so, we define where we're going to be, and we prefer to be the lead on anything in the state of Texas, and bring in those strategic partners. And if it's outside of the state of Texas, we're probably going to be a co-GP with it and not be the lead boots on the ground because of that knowledge gap. I would love to say we know everything about everything everywhere, but the reality is we just don't. And knowing your lane and when to stay in it inevitably takes out risk and makes the investors more money. And then your second question was the fund or doing a regular syndication.
Yeah.
So I'll give you a very honest answer to this. What a lot of people won't probably say is that when you're raising money, right? And let's just say you're wanting to diversify out, you're going to sell that, right? That's what you're selling to investors. We're going to diversify out and bring in a whole bunch of deals. With where we're at, we may have a particular investor let's just say he'll go $500,000 into every deal we do. And if we do a fund where we're going to go do 4 deals, right? He will do his $500,000. And even though we're doing 4 deals, he'll say, well, I'm done. I give you my $500,000. Whereas if I'd done it individually, he would have given us $2 million. Okay. Right. And so from an equity perspective, I think it's easier to raise from an individual basis. But from an ownership perspective, because I've invested in both too, I actually prefer just the syndication deals because one, I know exactly what I own, how much of it I own, and the focus is on that particular deal. So the information that I get isn't a fund information. I'm getting all the specifics to that specific deal. I think the fund does offer, like I said, diversity. You can have diverse, not just amongst areas, but product too. I've seen different products put into different funds. So there's pluses and minuses. So there's pros and cons to both. But as an operator, I prefer to go syndication routes because it's very specific. Here's what the deal is. This is what you own. You don't have to know that you own, 0.5% of this one and 2.5% of this one and 3% of this one, all within the fund. You own this part of this deal. And simple is just easier for me. I'm kind of a simple guy that way. And so most of the investors, if it's easier to explain to them, that's what I prefer to do. So.
I think also there's an edge for your background financing on raising capital. So how you manage to leverage this experience on one of the most important subjects, which is raising capital?
Yeah, so I've been doing it for a long time.
Yeah.
I mean, I've done it in other industries too, right? And so, mainly for banking. So most of our banks were capital raised through local investors. And so I've been around it for a real long time. And all it really is, syndication is really, really simple. It really is. And I like to break things down to simple concepts, right? You are there to pair money with an opportunity for whatever you're doing, right? You're pairing money with an opportunity. And are you doing enough work to able to concisely and clearly communicate what the opportunity is, and that it'll reach the goals associated with that the money wants? That's all it really is. That's really all it is. I mean, I hate to be so simple about it. That's what it is, right? And so if you're able to communicate clearly and concisely, here's the opportunity that we have, here's the money that we need, and does this match up and work? That typically is a successful raise.
Closing the deal.
Yeah, that's the successful raise, right? I mean, that's what it is. So
I think my last question will be, who is your influential mentor on your career?
Yeah, so most of my guys are banking world, because that's how I got started, right? And so, but it's interesting too, because when you're a small banker, right? So when you really are entrepreneurial. You are building a business to effectively one day sell it.
Yeah.
I mean, that's actually how I started. We were building a business to sell it. It's just a different avenue that we took, right? Versus a piece of real estate, we did it with the bank, right? And so the banks are extremely diverse. I mean, I have tons of products you can do, from your local car loan to your high-end office downtown, right? And kind of everything in between, and all the different businesses and services that do associated with all of that. But I had a mentor who started a local bank here in Houston, which is now a very large publicly traded bank. And I was fortunate enough to get connected with him when I was in college. And he pretty much showed me all the ins and outs of effectively doing business and how to do it and the right way to do it. And so it's a little bit more old school. And it's actually translated real well, right? I mean, I was a handshake banker for a long time. I mean, there really weren't that many of those kinds of guys. So I was big on character. I mean, if I knew that you will find a way to pay me back, the numbers really were secondary. The business was really secondary. The real estate, right? When you're looking at real estate deals, if I know that if I have the right team and we can put the deal together, I'm ready to go to battle with them. The real estate's almost secondary. I'm ready to go to battle with these people who are going to do what it takes to make sure that this deal is successful, and the real estate's secondary, which is why, I told you earlier at the beginning, back the jockey, not the horse, because, if you know that there are people behind that who are going to do everything they can to make sure that that deal is successful, and they put in the time to do the due diligence, they put in the time to the underwriting, you're taking a lot of that risk out of the deal. So, we measure risk real big here. I mean, that's a big deal to us, to continue to take risk out of the deal associated with the investment. And so, yeah, I mean, I'm conservative by nature. What I tell people is, I let a lot of pitches go. There are a lot of deals we probably could have done, but when I swing, we hit. And it's because I'm ready to pull the trigger on that, and I'm going to make sure that it is right down the middle, and we're going to be able to hit it fine, right? And so, you know, and particularly over the last several years, I let a lot of deals go that we absolutely could have done. We would have made great money on, right? But for one reason or another at the time, it just wasn't going to work, or there was risk out there that I didn't want to take. And so I'll take a lot of pitches, right? So we're not going to go out there and do 100 deals a year. We'll go out there and do a handful of deals, but they're going to be the right deals to put the investors in the best position to succeed, and for us in the best position to succeed. And so I've had, you know, several different mentors, but most of them were in the financial world, and teaching me how to observe and find risk associated in deals, and to look at what the plus and minuses are before you take that risk. So if the positives outweigh the negatives, then it's maybe acceptable. But when you're taking another person's money to put in the deal, that burden is heavy. And so you really got to make sure that you're making the best and wisest decision for not just yourself and your company, but for all the money that you're taking associated with it as well.
I think my favorite question to my guest always will be, how they think their superpower is.
Superpower. Wow. You know, I'm heavy analytical, heavy analytical. But one of the things, and I get to teach on it, I get to speak on it, is I deal with a lot of high IQ guys, and because of that, they have, you know, not to knock them, but a lot of them have lower EQ. And marrying those two, and I call it asset management, property management, because they really are different, right? But figuring out the best way to marry those two has been a great superpower of mine, because it's actually been what's been part of the success, right? And blending those two together, which are normally combative forces, to work together, that's been kind of the superpower in this industry that I have. I mean, I'm not scared of much. I have 3 teenagers in this household right now, so there's not much that can scare me property, right? And so, but that probably would be it, is the ability to blend those two and to bridge that communication gap.
So do you agree on less IQ you have, more money you're gonna make?
Not necessarily. I mean, I would tell you, Elon Musk is an extremely high IQ guy.
Yeah.
Bill Gates is an extremely high IQ guy. I mean, even Warren Buffett, he's an extreme high IQ guy. And so probably not. But I do think that the guys that are willing to take risk and just roll their sleeves up and get to work, they're going to be successful. And that doesn't matter what you're doing, right? I mean, you can be very successful. I mean, there are plumbers out here making a fortune right now that are not college educated, but man, they're ready to roll their sleeves up and work, and they're making serious money if that's how you view success. I mean, I think success is pretty subjective. So
100%. How the people can follow your success on social?
I mean, I would say join it. The website's probably the easiest way to get to it. So we're sunset-capital.com. From there, you can get onto our investor portal, and we do a monthly newsletter. We do pretty often updates. And so, we're on social too. So Instagram and Facebook, just look for Sunset Capital. We're there. And so we don't post as much as we probably should, but you know, we're working on that right now. And it's pretty easy. You know, I'm fine. If anybody wants to email, we have investor@sunset-capital.com, and we're pretty vigilant about getting back to everybody with that stuff too. So.
I think it was fun today. We had a lot of information about Texas. I hope that you like the show today, but we're really happy to bring you again to talk more about your success and more about Texas. And again, appreciate your time.
Yeah, and man, I'm honored, and I appreciate it too, bud. Really appreciate it. Thanks for the opportunity.
Thanks a lot, Sam. Thanks a lot.
Thanks, bud.